Hi, this is Sally's Book Club, bringing you the best global books every day. Today we're diving into the masterpiece, The Great Game. The Rise of Wall Street's Financial Empire. Authored by Wall Street veteran John Gordon, whose grandfathers both held New York SC seats, making him third-generation Wall Street royalty. Immersed in finance since childhood, Gordon earned his history degree from Vanderbilt University and became a professional economic writer. Interestingly, Vanderbilt University itself has deep Wall Street connections. Its founder, Cornelius Vanderbilt, was the last titan of Wall Street's classical era before J.P. Morgan. So we've got Wall Street veteran, financial tycoons, Vanderbilt history, and professional writing. Combine these elements and you get The Great Game. This book chronicles Wall Street's 352-year evolution from 1653 to 2004, longer than America's own history. Through sweeping narratives of key figures and events, it reveals how Wall Street became a global financial superpower. So, what were the decisive factors in this 3-century-long game? Today, we'll explore 4 pivotal forces through Gordon's research and historical archives. First factor: war. Wall Street's destiny has always been tied to warfare. The street itself was born from war. Its history began in 1653, when New Amsterdam, modern New York City under Dutch rule, built defensive walls against British invasion. But when the British attacked by sea in 1664, these walls proved useless. New Amsterdam surrendered without resistance. The British renamed it New York and tore down the ineffective walls. After demolishing the walls, the wide base became a street named Wall Street. Literally, Wall Street in English. You see, it was the Anglo-Dutch Wars that accidentally created Wall Street. The year 1653, when the Dutch built the wall, became year zero in Wall Street's history. Initially, Wall Street was just an ordinary commercial strip near Hudson River Port with unusually wide roads. Similar commercial districts existed in Boston and Philadelphia, some even larger. America was then an agrarian society, small farms in the north, slave plantations in the south. Beyond shipbuilding and blacksmith shops, there was virtually no manufacturing. If artist Zhang Zeduan had painted Wall Street then, it would have been a North American version of Along the River during Daziming Festival. Had history progressed linearly, Wall Street might have remained commercial, never becoming a financial empire. But the American Revolution disrupted this trajectory, freeing the colonies from British economic policies. Post-independence, the 13 colonies began developing domestic manufacturing in earnest. This created opportunities for Wall Street's transformation from commerce to finance. 3 subsequent wars shaped Wall Street: Civil War WWI and WWII. Pre-Civil War, the federal government spent $140,000 daily. By late 1861, daily expenditures soared to $1.5 million. This raised the crucial question: how to fund the war? Lincoln's administration had 3 solutions: tax hikes, printing money, issuing bonds. Taxes covered 21% of war costs. Unrestricted money printing addressed 13%, with capital markets covering the remainder. As Union victories accumulated and war production boomed, Wall Street entered a historic bull market. By 1865, daily securities trading reached $6 billion, making it the world's second largest capital market. In July 1914, as World War I began, Wall Street became the financial lifeline for Allied powers. War bonds were issued daily on Wall Street, channeling funds to Britain and France, much of which was spent purchasing American military supplies. This stimulated unprecedented agricultural growth and wartime prosperity in America. World War I played a decisive role in Wall Street's ascent as global financial power. In 1895, America needed Wall Street loans to survive crises. By 1916, the entire world depended on Wall Street financing. WTI transformed America from debtor nation to world's top creditor, with Wall Street replacing London as financial capital. World War I's impact was even more profound. Britain's devastating losses in WTI ended its financial dominance. The City of London became Wall Street's junior partner, marking Wall Street era's official beginning. U.S. corporate profits surged from $6.4 billion 1939 to $20.9 billion 1942 due to war demands. Post-war, civilian demands for housing, cars, and appliances fueled America's economic boom. Why does Wall Street consistently benefit from wars, domestic or global? America's unique conditions enabled its rise as financial superpower. But Wall Street wasn't America's only financial district. Philadelphia hosted America's first Bank of North America, Stock Exchange 1790, and Central Bank, First Bank of the U.S. Why didn't Philadelphia become the global financial hub instead of Wall Street? This leads us to the second key factor in Wall Street's rise: infrastructure development. The crucial infrastructure development for Wall Street was the opening of the Erie Canal. Stretching 584 kilometers from Buffalo on Lake Erie to the Hudson River estuary in New York. The Erie Canal cost $7 million, an astronomical sum at the time. This canal opened the Midwest's access to Atlantic trade, cutting transportation time to New York by 2/3 and cost by 95%. Result: New York's population grew from 100,000 pre-canal to 1 million by 1860. Before construction, New York handled less than 10% of U.S. imports. By 1860, that share reached a staggering 62%. The Erie Canal cemented New York as America's premier economic hub, leaving Philadelphia behind and elevating Wall Street. As New York's financial district, Wall Street leveraged massive infrastructure, financing, and trader-driven credit expansion. Bonds and stock offerings became the financial wizard spells. Unprecedented economic growth fueled an unprecedented capital market boom. Wall Street became America's financial capital, with New York emerging as its dominant market. The second crucial infrastructure was railroads. In the 1830s, Wall Street faced collapse and global distrust. European capital avoided Wall Street like the plague. Rothschild, Paris director, told booksellers, "Tell your government, Europe's financiers say America can't borrow a cent here. In capital markets, confidence is more valuable than gold." With Wall Street's credit ruined and confidence vanished, what could be done? Railroads became Wall Street's savior, requiring massive capital beyond individual means. They demanded innovative financing solutions. Only through capital markets using bonds and stocks could society's capital be pooled for such investments. Incrusted projects provided prime securities. Railroad investments were the most lucrative of that era. American capital flooded into railroad bonds and stocks like never before. At its peak, on a third of all U.S. traded securities were railroad-related. In turn, railroads' economic returns fed back into American capital markets. This created a virtuous cycle between capital markets and real economy. By 1843, after 5 bearish years, America's economy and markets finally rebounded. Canals and railroads. America's belt and road-style infrastructure projects powered economic growth, with Wall Street dominating key financial nodes. Now we examine Wall Street's third growth driver. Innovation. Innovations fueling Wall Street span 4 areas: technology, systems, concepts, and participants. The telegraph stands as history's most admirable financial technology innovation. Capital markets fundamentally influence economies through price signals determining resource allocation. Pre-telegraph price transmission relied on foot messengers, slower than ancient Greek military runners at Thermopylae. This technological lag allowed regional U.S. markets to persist before telegraphy. Real-time price transmission via telegraph changed everything. Regional financial centers became obsolete. America's capital increasingly concentrated on Wall Street. Next, let's examine institutional innovation, which has been integral to Wall Street's history. Earlier, we discussed how war created Wall Street geographically, but institutional innovation forged its financial identity. In 1789, Federalist Alexander Hamilton became Treasury Secretary. To address war debts, Hamilton implemented 3 reforms: unified federal taxes, government bonds, and a central banking system. Hamilton's policies reshaped America's economy and laid Wall Street's foundation. Federal taxation created the basis for issuing government bonds. With bonds came tradable securities. The banking system, comprised of early joint stock companies, introduced equities. Combined bonds and stocks formed the complete securities system and trading market. In this sense, Hamilton can be called the father of Wall Street. The second groundbreaking institutional innovation was the Federal Reserve's creation. The Federal Reserve serves as America's central bank, as commonly known. Americans were actually familiar with central banking concepts. In 1791, shortly after independence, Americans established the first Bank of the United States, modeled after England's central bank. But in 1829, President Andrew Jackson shut down the central bank. For the next 80 years, America suffered without a central bank. During this period, Wall Street oligarchs emerged as de facto central bankers. The legendary J.P. Morgan epitomized this era, beginning with Civil War financing. Post-Civil War, America returned to the gold standard, abandoning Lincoln's greenbacks, causing deflation. Under pressure from farmers and silver interests, Congress authorized free silver coinage at 16:1 silver to gold ratio. Silver supplies surged, driving market rates to 20:1 against gold. With official rates fixed at 16:1, obvious arbitrage opportunities inevitably attracted market manipulation. Gold reserves began rapidly draining from the Treasury. The government even issued $100 million bonds on Wall Street to buy gold. but it proved futile. Purchased gold quickly vanished. By early 1895, facing national bankruptcy, President Cleveland summoned Wall Street's mastermind, J.P. Morgan, for consultation. President Cleveland quietly asked, from behind the Oval Office desk, "What do you suggest?" This moment marked Wall Street's ascendance. Even the U.S. government sought its help. Morgan then resolved the crisis. Morgan and Rothschild simultaneously underwrote U.S. bonds in New York and London to purchase gold, quickly selling out the offering. By June 1895, U.S. gold reserves stabilized at $107.5 million, averting national bankruptcy. At the century's turn, under J.P. Morgan's de facto central banking leadership, Wall Street bankers were building a modern industrial nation. Securities trading continuously funded America's industrial expansion, most notably through Morgan's creations, General Electric and U.S. Steel. U.S. Steel launched with $1.4 billion capital, commanding only a third of America's total $9 billion industrial capital. A Wall Street joke circulated. Teacher asks, "Who created the world?" A boy answers, "God made it in 404 BC, but Mr. Morgan 重组 at in 1901." Then came the Wall Street White House War. The same year Morgan reorganized the world. Progressive President Theodore Roosevelt took office. Roosevelt feared financial capital controlling industry, creating monopolies, threatening free markets. His administration passed the Sherman Antitrust Act, dismantling Wall Street oligopolies through government intervention. J.P. Morgan's Northern Securities Company was forcibly shut down. Chaos engulfed financial markets. Against this backdrop, a suspicious copper stock speculation emerged on Wall Street. This speculative scheme nearly plunged the U.S. economy into financial panic. Recall, President Jackson closed the Second Bank of the United States in 1837. Since then, America lacked a central bank to issue currency or inject liquidity. Facing this crisis, the government stood powerless. Roosevelt again summoned J.P. Morgan to the White House. Morgan convened Wall Street tycoons at his private library that night. The elder Morgan remained in the adjacent room smoking and relaxing while others negotiated. After reviewing their proposal, Morgan approved it with cigar in hand. Overnight, market liquidity was restored, averting disaster. Absolute power corrupts absolutely. Central banking power shouldn't rest with one man. This prompted determination to rebuild central banking system. In 1913, the Federal Reserve System was established. J.P. Morgan died later that year, ending an era. Third major innovation came from Franklin D. Roosevelt's reforms. Post-World W.W.I. Fed chair Benjamin Strong maintained ultra-low interest rates. Intended to aid European recovery, this policy had unintended consequences. Artificially low rates fueled reckless market speculation. This speculative frenzy mortgaged America's economic future. The inevitable Great Depression descended like Judgment Day. What impact did the Great Depression have on Wall Street? Simply put, the Dow Jones fell from 381.17 on September 3, 1929 to 41.22 on June 8, 1932, an 89% collapse. 90% of banks failed. Surviving ones hoarded cash, refusing loans. The Fed implemented high interest, tight monetary policies, draining market liquidity. Wall Street resembled a train entering an endless dark tunnel. In 1933's turmoil, Franklin D. Roosevelt became president. FDR launched three landmark reforms: Emergency Banking Act, Securities Act, and Glass-Steagall Act. The Securities Act mandated SEC registration and disclosure for stock offerings. It outlawed market manipulation, granting SEC discretion to define violations. Glass-Steagall created FDIC insurance for deposits under $50,000 to prevent bank runs. Banks had to choose between deposit services or securities underwriting. Commercial and investment banking became separate entities. Existing universal banks were forced to split. Joseph P. Kennedy, JFK's father, became first SEC chairman, strictly enforcing reforms. New YSE president Richard Whitney's removal sent shockwaves through Wall Street speculators. FDR's reforms transformed Wall Street into the system we recognize today. The fourth 20 institutional innovation for Wall Street was securities industry franchising. This innovation was pioneered by Charles Merrill, founder of Merrill Lynch. Merrill revolutionized securities brokerage by applying chain store models similar to bank branch networks. Merrill Lynch offices spread across America and overseas, bringing stock trading to households. Middle-class Americans gained stock market access for the first time. Responding to critics, Merrill once asked, "What is Wall Street?" "It's Montgomery Street in San Francisco, 17th Street in Denver, Marietta Street in Atlanta. No different than any main street where people invest." Merrill's franchising permeated all social strata through neighborhood brokers. The fifth crucial innovation: Intermarket Trading System, ITS. The 1975 Securities Act amendments mandated a national market system connecting all exchanges. Post-Home 1975, New York SE, and competitors developed ITS operational by 1978. ITS connected New YSE with 9 markets, including NASDAQ, enabling full price transparency. Best prices emerged from largest markets. Financial gravity in action. By late 1980s, 2 markets remained: New York SE blue chips and NASDAQ growth stocks. Today, NASDAQ often surpasses New York SE in volume, though New York SE maintains higher market caps. Most New York SE listed companies still hold greater valuations than NASDAQ counterparts. In 1982, the Dow Jones Industrial Average broke through 1,000 points for the third time and never fell below that mark again. These were Wall Street's 5 most significant institutional innovations: Hamilton's reforms, the Federal Reserve's establishment, FDR's New Deal, securities franchising, and intermarket trading systems. Moving beyond institutional innovation, we now examine conceptual innovation embodied by Benjamin Graham. Benjamin Graham, mentor to Warren Buffett, revolutionized Wall Street by introducing fundamental analysis and value investing principles. Before Graham, Wall Street lacked stock valuation standards, dominated by market manipulation and speculation. Graham's success demonstrated fundamental analysis' importance, establishing investment as superior to speculation. He founded modern security analysis, introducing concepts like corporate operations, capital, and cash flow. These concepts now form the foundation of global equity analysis. His book Security Analysis became the Bible for capital market participants. Warren Buffett famously said, "All those who truly understood Graham's work became wealthy." Finally, we examine innovation in trading participants. Historically dominated by speculators, Wall Street's most twatty figure was Jacob Little. Pre-Little, Wall Street teamed with insider traders and fraudulent operators exploiting partners. Little emerged as an independent broker using analysis rather than insider information, pioneering short selling and market timing. After Little, speculative trading became Wall Street's dominant practice. This pattern persisted until post-Korean War reforms. Following the 1953 Korean armistice, institutional investors like pension and mutual funds emerged, reshaping market dynamics. In 1950, mutual funds managed just $2.5 billion in assets. By 1960, their assets surged to $17 billion and kept growing rapidly. Like the rising sun at dawn, their ascent seemed unstoppable. In the early 1960s, institutional investors like mutual funds revolutionized market structures. Capital demands broke Wall Street's century tradition of not selling shares to the public. To raise capital for modernization, firms transitioned from partnerships to public corporations. Merrill Lynch became the pioneer in this transformation. In 1971, Merrill Lynch became the first exchange member to go public. This participant innovation fundamentally reshaped Wall Street into today's mature financial market. We've now covered Wall Street's three primary growth drivers. To recap: war, infrastructure, and innovation. Anglo-Dutch conflicts birthed Wall Street Civil War, and world wars propelled its dominance. Post-WWI cemented Wall Street's global status. WWI solidified its supremacy. The Erie Canal and railroads helped Wall Street outcompete regional rivals to become America's financial capital. Innovation emerges as the critical internal catalyst in Wall Street's rise. Technological, institutional, conceptual, and participant innovations each played distinct roles. These innovations drove Wall Street's internal evolution through complex market dynamics. Interactions between internal innovations and external forces, like war, created grand historical synergies. Finally, an intriguing historical footnote: California's gold discoveries unexpectedly fueled Wall Street's growth. The Mexican-American War from 1846 to 1848 ended with U.S. victory, making California American territory. That same year, American immigrants discovered gold in California's mountain rivers. This triggered an unprecedented surge. U.S. gold production increased 70-fold within 5 years. In this gold standard era, gold meant credit and currency. America's gold empowered Wall Street to attract reluctant European investors. Through California's gold under the gold standard, America gained influence over European capital flows during the 1850s. As a historical contingency, California's gold discovery boosted global confidence in Wall Street, accelerating its financial dominance. That concludes today's book insights. Find keynotes below the audio. See you tomorrow.